So, hey guys, welcome back to Accelerated Investor. On this episode, I'm going to be interviewing Yonah Weiss. Yonah is a powerhouse for property owners, whether you own apartment buildings, whether you own single family residences, whether you own duplexes, multifamily, office, commercial. He is the business director of a company called Madison Specs. They're a national cost segregation leader. He's been on over 100 various podcasts sharing his advice about how to save money through advanced depreciation strategies. In this particular interview, which you're going to hear in just a second, Yonah and I talk about what he's working on right now and how he's hosting weekly meetups and he's doing breakouts through using his Zoom technology, which you all have access to, and doing weekly meetups, but also doing breakouts to get clients. We'll talk about what cost segregation is and how properties have three separate buckets of kind of material within the property, three main categories, and how they can each be written off on separate depreciation schedules, the main structure, the land improvements, and the personal property. We'll also talk about my building and what benefit I would have to doing cost segregation on my own brand new 80 unit apartment building that I just purchased. And we'll also talk a little bit more about some of Yonah's clients and the amount of money that they saved as a passive investor when they were actually able to use the term real estate professional and actually use the deductions against their own personal tax returns. You'll love this interview with Yonah Weiss. Take a listen.
Welcome to the Accelerated Investor Podcast with Josh Cantwell. If you love entrepreneurship and investing in real estate, then you are in the right place. Josh is the CEO of Freeland Ventures Real Estate Private Equity and has personally invested in well over 500 properties all across the country. He's also made hundreds of private lender loans and owns over 1,000 units of apartments. Josh is an expert at raising private money for deals, and he prides himself on never having had a boss in his entire adult life. Josh and his team also mentor investors and entrepreneurs from all over the world. He doesn't dream about doing deals. He actually does them, and so do his listeners and students. Now sit back, listen, learn, and accelerate your business, your life, and your investing with the Accelerated Investor Podcast.
So Yonah, listen, thank you so much for jumping on with me today on the Accelerated Investor Podcast. Appreciate you taking some time. You are a busy man. We're talking about cost segregation. I've seen you on a bunch of other podcasts. You're definitely one of the industry experts. So Yonah, thanks so much for joining us, but tell us right now, what is something that you're working on right now today? We're kind of winding down 2020. It's been a wild year with COVID, but there's a lot of positivity, positive things still happening in the marketplace. What's one of the things that you're working on that you're most excited about?
Oh, well, thank you, Josh. It's really a pleasure. I tell you, one thing that I'm working on that has really blown my mind is I started a virtual meetup, a real estate meetup virtually a couple months ago. It started in the midst of, back in April when we were like all trapped at home and everyone's like, I have all these events planned for the rest of the year and my local meetups and all this stuff. And networking is huge for me. I love to go to these events. I love to meet people. And it's just like, what can we do? Mm-hmm. I got on a call and I saw they had this really cool feature on Zoom that allows for breakout rooms, which you can actually, if you're on a big Zoom call with a lot of people, you can actually click a button and break that Zoom call up into little groups of 2, 3, 4, however many you want. And so I literally that day, I'm like, okay, I'm doing this. I started a weekly meetup. And so we meet every single Wednesday. Usually about 50 to 100 people are coming. We get a guest speaker every week on a different topic, real estate related. And then we do these networking breakout rooms. We're meeting tons of people from all over the country. It's really incredible. I'm really excited about that. And that's my favorite project I've been working on recently.
That is fantastic stuff. So let's back up for a second. You are really out talking to a lot of groups, your own groups, podcasts, specifically about cost segregation. You're an expert in it. Your firm is an expert in it. Why don't we jump in for those of our audience? We've got, about half of our audience is residential investors. The other half owns a lot of apartment buildings and commercial real estate. And I don't know that many people are really familiar with what cost segregation is. That's what your firm does. You're one of the nation's leading experts in it. And this is available to them in a way to basically have the government reduce your taxes in exchange for owning real estate. So what is cost segregation and why aren't more people talking about it?
Excellent questions, right? A great preface to that. I think it's just understanding, and I'll answer your second question first, because why don't people know about this? It's really confusing. I mean, first of all, it's a weird name, but second of all, taxes, when people think about taxes, like their brains kind of freeze, right? Mm-hmm. They're like, shut off, and they're like, I have an accountant, I'm sending it to my accountant. Well, the thing is about cost segregation, even though it's an accounting method, it's actually an engineering service. So accountants don't do this. Which means that even though, you think you're relying on your accountant for everything tax related, well, guess what? This thing here is not something accountants do. So therefore, you may be missing the boat because your accountant may not be, prioritizing or just being proactive enough to tell you about something like this exists. So now that we know perhaps why you may not have even heard about it,
sure.
Let's just jump right in. What is it, right? That was your first question. What is cost segregation? It's a weird name, and let's just break down that name, which is the cost and segregation. We're taking the cost of a building and we're segregating it. We're basically splitting it up into different categories that depreciate at different rates. So essentially what we're doing is an advanced form of depreciation. Okay, so let's take a step back maybe and understand, well, hey, what's depreciation? I mean, I know what it means, right? Like something's going down in value, right? I don't want my property to be going down in value. So why is this a good thing? It doesn't sound good, right? Well, it is good. It's actually
one of the most beautiful things in the world.
Yeah, it's incredible. It's one of the most incredible things. I mean, for me, I love it. But what people don't understand is that when you talk about real estate, it's always, kind of lumped together all these benefits of real estate, right? The passive income or the equity, the wealth building, et cetera. And tax benefits is always like lumped in there, right? Mm-hmm. What's the tax benefits? I mean, the biggest one is depreciation. And cost segregation is just an advanced form of that. So let's understand that. Depreciation means that something goes down in value as time goes on. But for real estate and for tax purposes, it's just a borrowed term. Okay, it's a borrowed term. That means that the IRS gives you a tax deduction of your property, the entire value of your building. When you buy a new building, from the day that you buy that, you now get to take that as a tax write-off over a certain period of time. So 27 and a half years for residential, 39 years for commercial. So that's what we're doing. We're taking income tax deductions, income tax write-offs, because we bought real estate. And essentially that's what depreciation is. And I say it's a borrowed term because it's not intrinsic to the property itself, because it starts that schedule, that amount you can actually write off as your property's going down, starts the day you buy it, which means it may have been fully, quote unquote, depreciated. The value's been, quote unquote, gone down on it. And now you buy it, it starts over.
Right. So one of the most beautiful things about real estate is we buy properties, let's say at a wholesale price, put in some CapEx, improve the building, whether it's a residential building, whether it's an apartment building, whether it's a medical office building, whatever it is. And we try to force the appreciation through these value add improvements and increase the rent. So, we're into the building, let's say for 70 or 80 cents on the dollar, and it's worth more because we put in the CapEx, we put in the value and it's worth more. And the building is valued at a higher price. So we've already got some equity built in. That's one of the kind of pillars of building wealth. The next piece, like you talked about, is the passive income that comes after expenses and debt service. You've got net free cash flow. That's amazing. You've got the property appreciating in value as your rents go up or as time goes on, things naturally appreciate in value if you take care of them. But there's this weird thing of depreciation that many people maybe don't understand. A lot of our real estate investor clients understand it, where the government allows you to write off the cost of that over 27 and here's residential, 39 for commercial. It's this weird just tax deduction, right, for owning real estate because the building's really not going down in actual value. So I love to tell people the building appreciates in value, but get to write it off on your taxes. So most accountants, to your point, will say, hey, we're going to depreciate this on your taxes and you're going to pay a little bit less in tax. So Let's just explain that for a second, Yona, why accountants just generally say, well, here's the schedule, 27 and a half years or 39 years for commercial, and you get to write this off. That's the normal depreciation schedule. Talk about that. And then what is the advanced method, the cost segregation method? Again, high level, then we'll get into the detail.
Absolutely. So high level is we take that purchase price. Okay, you bought a building for $1 million. Maybe we'll do an example, an actual case study later on. But let's say $1 million. Immediately you have to subtract a certain amount for land. Land does not depreciate. And the rest, whatever's left over, let's say you take off 10, 15, 20% for land. Okay, let's say 20% just to keep round numbers. That $800,000 that's left, that 80%, that's your basis. That we're going to divide, your accountant is going to just divide that 800,000 by 27 and a half. Okay, so you're going to be left with, for a residential property, multifamily is considered residential for this as well. You're going to be left with approximately $30,000 a year. Okay, maybe $28,000 a year for your depreciation write-off. That's what that means. So what that means is you make your net operating income after all expenses, after everything. Let's say you made $50,000 on this $1 million property, net operating income. Immediately you deduct $30,000 from that. That's your depreciation expense, and you're only taxed on the remaining $20,000 in our example. Okay.
Beautiful thing.
That's simple, straight line, right? Regular depreciation. That's what your accounting is doing. What the IRS actually says is that there are, everything in the building, everything on a property really depreciates. Everything has a schedule, has a different useful life. And that's the word they use, a quote unquote useful life. And so there are many things in a property that actually have a much shorter useful life, which means you can take the value of those as a tax write-off over a much shorter period of time. So that's what cost segregation is. An engineer is coming in and identifying what all those things are and how they apply to the tax code to have shorter useful lives.
My newest and most powerful real estate investing book, The Flip System, is now available. And for a limited time, you can grab your free copy at getflipsystem.com/podcast. Using the same proven principles, secrets, and investing strategies I'm sharing in this book, I've been able to personally close over 750 highly profitable real estate deals over the last 15 years, make over 400 private lender loans, raise over $30 million of private money, and acquire over 2,000 units of apartments. Get my newest book now for free for a limited time at getflipsystem.com/podcast. That's getflipsystem.com/podcast. So you want to give us a couple of examples, like certain walls, certain windows, roof, certain things have different useful lives. So throw out a couple of examples. What's like the useful life of windows or a roof or whatever? Give our audience some examples of what that could be, where instead of depreciating the whole commercial building over 39 years or the residential over 27 and a half, you can segregate them out and say these other items we can depreciate much faster, which means you get much larger tax deductions. Give us some examples there.
So basically the examples are, there's three main categories, and everything fits into these three categories. Or not everything, 95% of everything in any type of commercial property fits into these three categories. There's the main structure of the building and structural components. That's all what really depreciates on the 27 and a half year. And then there's two other categories which we're going to be segregating out. There's what's called the land improvements, which depreciate on a 15-year schedule. And some examples of that would be like landscaping, pavement, if you have a parking lot, right? Asphalt, curbing, fencing, signage. Basically think about anything outside of the building. That all has value to it. And when you identify the value, you can take that value as a tax write-off over a 15-year period. So it's much faster, or at least half the amount. The second category, or the third category, I should say, is called personal property, and this is really the main category that gets segregated out from the building. And this includes anything that's not structural. So let's go back to the structural for a minute. Structural is like the roof, the walls, the floor, the windows, doors, main electric, main plumbing. All those things are considered structural, integral to the property. And those are all on a 27 and a half year schedule, which means once I can identify what the value of each one of those things are, I'm going to take the value of the structural things, windows, doors, roof, etc., on a 27-year schedule. The 5-year property, the personal property, actually depreciates on a 5-year schedule. So think about furniture, appliances, okay, carpeting or vinyl flooring, even though it's like floor, but it's not the actual floor. It's on top of the floor and it can be removed. So therefore it's a 5-year schedule. There's a lot of value in that. Wall coverings, certain types of outlets, fixtures, electrical, lighting, all that kind of stuff, even cabinets and countertops, which again, they're not structural. These are add-ons. These are things that you can take in, take out and replace. All of that is a 5-year useful life, which means you can identify what that is. And we're not even talking about new construction. We're not just talking about the, doing the value add, the CapEx, like you said, what you're putting in value into the building, replacing things. Just on the acquisition, you buy a building, even though this stuff has not been replaced for 30 years. Yeah. Okay. You can now come in and say, no, this actually has a 5-year useful life. And based on the purchase price, I'm going to allocate a certain percentage, maybe 20% of the value to all of this 5-year property and take that as a tax write-off over the first 5 years.
Fantastic. So let's do this. I've got a building that I am closing on next Friday. And by the time this is released, thank you. But I appreciate that. I love new acquisition stuff. So this will be released shortly after that. And so let's talk about this building. So we're buying an 80-unit apartment building. Purchase price is $3.745 million. Capital improvements, CapEx, is $350,000. And most of that, we're turning 40 of the 80 units. So we're going to turn 40 of them. We're going to invest about $7,000 a unit in flooring, paint, carpet, but update the kitchen, update the bathrooms. Again, a lot of these are one bed, one bath. So they're only 500 square feet. So 7,000 goes a long way.
Yeah.
And then the other roughly $70,000 that's remaining is going to go into improving some of the additional bathrooms. We've got some small point of sale violations from the local city building department. Not much, but maybe $10,000 in concrete work, stuff like that. The unit mix, I'll give you the unit mix real quick. It's 41 ones. It's 22 ones and 23 ones. Okay, so it gives you an idea of the unit mix and the size. But we'll be all in for it for the $3.7 million plus 350, plus some soft costs and stuff like that, about $200,000. So for attorney fees and closing costs, lender points, etc., all in for, call it 4.3, 4.4 roughly. It pencils out based on the improved NOI, $380,000 of NOI after it's improved, and the rents go up. And then based on a 6.25 cap puts the value at 6.1 million. So those are all kind of, rough numbers, general numbers, just to keep this conversation moving along. So, all in for 4.3-ish, new value 6.1. Plan is to then refinance within about 2 years after we improve those 40 units, pay off the original loan and the CapEx, return the investor's equity, and put a new loan on it. Obviously, interest rates being so low, it makes a lot of sense.
Right.
New loan at about 4.5 million. And we'll be able to cash everybody out, have a permanent loan on it. Okay. So now I could depreciate that sucker from the time I bought it. Okay. Over the next 39 years. But we've got these 3 buckets, the main structure, we've got the land improvements, and then the personal property. So help me and my audience understand what would we be looking at under a cost segregation study based on the existing building, and then this CapEx that we're going to do. How might this be able to be divided up to give us these new tax benefits and accelerate that depreciation on this building? Excellent
question. So I'm gonna add in one more big point into this discussion before we get into breaking out your property. It sounds like an incredible business plan, right? And I'd love to understand how the tax benefit is going to play out here. But there's one really important point that goes along with this, which is something called bonus depreciation, which is it's actually a relatively new tax law that came about in 2018 with the Tax Reform, Tax Cuts and Jobs Act. And it says that once you do a cost segregation study, this is what the tax law says, and you're breaking out, you're identifying the things that depreciate at a faster rate, 5-year, 15-year. Remember I mentioned the personal property, the land improvements. You have the option to take all of that in the first year as a first-year tax deduction, which means you can lump it all together and take a huge tax deduction in the first year. So I'm going to just throw that out there, and then I'm going to use that to apply that as well when we break down and understand this example. And I'm going to give you some high level numbers. This is not accurate. I don't know. What we always do actually is our engineers, which is really the bulk of the work of the cost segregation, is the engineers that understand the construction of the building, break everything out. We'll actually run a free estimate for anyone, which they'll look at a lot of details in the property and just give, based on the 15,000 studies we've done, and take that data and take the data of the what's in the property, the unit count that you mentioned there, the square footage, et cetera, and tell you based on a whole very detailed process they go through to tell you what your tax benefits would be. So what I'm going to do is going to be very high level. It's going to be very estimated, but they'll do a much more accurate estimate. So ahead of time, even before doing a cost segregation study, what you can potentially get from it.
Are you ready to automate and explode your real estate investing? We're searching for extremely motivated individuals who are sick and tired of wasting time and want to finally see real results from their real estate investing business. We're searching for investors looking to get to the next level and become a bigger, better version of themselves while being a more successful real estate investing entrepreneur. Apply for mentoring and coaching at joshcantwellcoaching.com/podcast. That's joshcantwellcoaching.com/podcast. So our audience understands we're looking at the comparison between the normal depreciation schedule, which gives us a certain amount of write-offs over 27 and a half years resi, 39 years commercial, versus doing this study, identifying the 3 buckets, and then what can be depreciated much faster through cost segregation study and this accelerated depreciation. That's the second option. Then Yona's also going to talk about what we call bonus depreciation, which was added to the tax code in 2018, which is a whole nother opportunity, which we'll talk about again, high level. This would be really detailed in this free estimate, which I'm sure Yona's going to give us some contact information. We can reach out to him throughout the podcast or at the end of the podcast, reach out to him and his firm to get this done on your own building. So high level, tell me about my building. How would that go?
Yeah. Okay. So let's take a round number, right? You said about $4 million all in, including some of the soft costs. Not all the soft costs will be depreciated. But let's just take the $4 million just to keep it simple. And actually, let's even not include the upgrades, because the upgrades might not take place in 2020. You might take place in 2021. Sure. I'm not sure, but that's actually separate. The acquisition cost, that's depreciation. The upgrades, the 300,000 that you're putting in, 350,000 you're putting into the property, that's actually something separate. We're going to get to that in a little bit. So let's just take the original purchase price, right? You said 3.745.
Yep.
And we're going to divide that by 27.5, because commercial, even though it's a multifamily, it's considered residential for tax purposes. And even though from a loan perspective, we consider commercial. Yep. So your regular depreciation would be approximately $136,000 a year. Okay. Which means, sounds great, right? You said NOI is going to be,
380. Yep.
Yeah, 380. So it looks like immediately you're going to be knocking off from your $380,000 of net operating income about 136, right? So you're looking at only being taxed at right about 225,000. Okay, that's pretty good, right?
Absolutely.
Instead of being taxed
saving us $50,000 to $75,000 a year in actual tax.
Exactly, just from the regular depreciation. So that's the government's incentive. Okay, so now with cost segregation, we'll come in and take a look at all the interior. We'll look at how much of the personal property is in there. Let's say it's about 20%. That's pretty average. Say about 20%. So 20% of 375, 3745 sorry, excuse me. We always have to allocate a certain amount for land, which I didn't do. I apologize. So let's say 20% to land, which is pretty average. So that's what we're going to do. We're going to be left with. So that's going to even reduce your regular depreciation even more. So instead of 136, it's going to be more like 120. So 20% of that means you're going to be looking at about $700,000 approximately of extra depreciation that you're going to take over the first 5 years. So how that looks is, right, pretty cool, right? $700,000 divided by 5 years means you're going to be looking at approximately $140,000. You're going to be doubling your depreciation, a little more than doubling your depreciation expense in the first 5 years, but it's still not going to get you to zero, right? You got 380 of income and about 280 now of depreciation, right? Or 260. So you're going to be lowering your income tax liability tremendously and saving a whole boatload of taxes. However, let's bring in this bonus that we talked about. Okay, so the first 5 years you're going to be essentially knocking down your income tax liability by 50%, right? Right. That's just simply by doing regular cost segregation study. Take bonus depreciation, and what bonus depreciation says is you can actually take that full amount, so that 20%. And it could be even more. It could be 30%. I'm just giving a very conservative round number. So $700,000 you can take in the first year. So what would that look like? So you take your regular depreciation of 120, right? And add 700,000 to that, you're going to get, $820,000 of depreciation. Well, if you only have 380 of income, so you have more deductions than you have income. Well, what happens then? More deductions than incomes means, first of all, you have zero tax liability, pay zero income tax that year. And whatever is left over, two things can happen. Number one, the first thing that always happens is that it will carry, anything left over will carry forward, you can use next year. Okay, which means you use next year, and whatever's left over from that, you use the year after that. And so you're looking at a much bigger tax deduction in the first couple of years, 2-3 years. However, there's something really awesome that can happen if you are a real estate professional. And many people don't know this. A good friend of mine, his name is Brandon Hall, CPA. He runs a tax firm called the Real Estate CPA. He just published a brand new an ebook called The Real Estate Professional Guide. Essentially what this is, there's a tax status called the real estate professional. If you are this, which means you spend more than 50% of your time in real estate traded business, okay, either you or your spouse, okay, only one of you needs to qualify for this, then you can use your depreciation deductions to offset any of your active W-2 income or any other income from any other source as well, which is huge, okay? And this is really where cost segregation comes in as a game changer, because normally depreciation is considered a passive deduction, and it normally only goes to offset passive income. Rental property income is considered passive income. If you have multiple properties, you can use depreciation from one to use to offset income from all of your properties. It goes across the board. However, it's limited to that. Okay, you can't just use that deductions for anything unless you are a real estate professional. Once you get this golden card,
my card carrying member.
Card carrying member, exactly. You get to now use your any extra depreciation to offset any other income you have. So in our example, let's say in your property, you have this extra $500,000 of tax deductions or tax losses this year. What are you going to do with all that? Right. Either you can carry it forward and use it next year, or even better, if you have any other income, let's say you made money from the stock market and you're a real estate professional, or your spouse has a W-2 income, you can now use that extra $500,000 of depreciation to offset their income as well, and literally get to the point of paying little to no taxes whatsoever.
Fantastic stuff. Yona, listen, I've got this building we'll be closing on by the time this podcast gets published. We need to talk shortly after the purchase happens.
Of course.
and get that conversation going. We own over 2,700 units of apartments as a general partner with our other JV partners and things like that. So there's quite a bit to discuss. Yona, before I let you go and before we wrap up, tell me about one of your favorite cost segregation stories for one of your clients. Obviously, we don't have to tell the client's name, but in general, give an example of a recent maybe cost segregation study that was done on a different type of asset, maybe a mall or maybe a large medical office building, and some of the savings that happened for the client, and kind of the client's reaction, maybe if you are aware that when the client realized, holy smokes, I just saved hundreds of thousands or millions of dollars in tax because I did this, because the study is going to cost some money, right? So there's an investment up front, and then there's the return on investment, which is all the tax savings. Tell us maybe about one of your other clients and what they've experienced.
Sure, and it's really rewarding because there's so many stories that happen, and so many people that are just like literally their lives are changed by not paying taxes. I'll share with one that I haven't shared before. Is a woman, a client of mine, who was in IT for many years. She worked for some of the biggest, companies, tech companies, and she invested passively for many years in real estate syndications, in deals. And she was a co-GP as well for a couple of years. She started getting involved in that. She started seeing the returns she was getting, all these tax losses, all these, negative K1s that she was getting. And she was like, well, they're not even getting put to use because I'm not a real estate professional.
Sure.
So literally, she made the calculation. She was investing heavily for, 6-7 years. And she was basically taking all of her income from her high paying job and putting it into real estate. She literally made the calculation at a certain point that said, if I quit my job and I start making, spending more time involved in real estate, I will have more money coming in net from all of the tax deduction, because she's literally not going to pay any taxes. So literally she went, and I got such an incredible note from her saying that she was able to literally quit her job and pursue her passion, which was real estate, full time, and obviously spend time with her family much more because it's not that involved, and she spent the last couple of years has not paid $1 in income tax.
Wow.
And she's making more money than her high paid IT job.
Yeah, I've got it. As soon as this podcast is released, we've got over 200 passive investors that invest in our deals, our apartments, our private equity fund. They are going to want to hear that piece that you just told. Some of them are exactly that person you just described. High paid doctors, attorneys, IT professionals, etc., making a large income, investing in a lot of syndications with us and other sponsors. And they'll be excited to hear that there's a point where they may be able to use those massive deductions against their W-2 and against and pay little or no tax and almost be able to slow down and retire because of tax benefits. It's amazing story. Yona, listen, as we wrap up, I know there's a big section of our audience going to want to learn more about this, maybe talk to you directly about their buildings, future buildings they're going to purchase. What are some ways that they can get in touch with you and your firm?
Best way to find me is actually on LinkedIn. I'm very active on LinkedIn. Every day you can find me there. You can also go to yonaweiss.com and find out more about what's going on with me. My podcast, the Weiss Advice Podcast, is over there as well. And you can check out our company again, Madison Specs. We're the largest national company that does this, work in all 50 states. And yeah, feel free to reach out. My email, maybe put that in the show notes, was yweiss@madisonspecs.com. So happy to speak to anyone. And like I said, the free analysis is like a no-brainer.
Fantastic. Yona, listen, thanks so much for joining us today on Accelerated Investor. Had a blast with this interview.
My pleasure, Josh. Thank you so much for having me.
So there you have it, guys. I'm so excited to have interviewed Yona for the Accelerated Investor podcast. If you enjoyed that interview, please go to iTunes right now. Leave us a 5-star rating and a review. And when you do, send us a screenshot of your review and we will send you a free Accelerated Investor t-shirt. Thanks so much for doing that. Also, share this episode on social media, LinkedIn, Instagram, Facebook. Share it with your community so that we can have other people learn from the Accelerated Investor podcast, the solo cast, and the interviews that we've done. Also, don't forget to catch the actual face-to-face interview on YouTube. Check it out on YouTube. Again, leave us a rating and review. Make sure you subscribe to our YouTube channel. And for all of you that are engaging in our accelerated investor community. If you're not inside of our private Facebook group, go ahead on Facebook right now and make sure you find Accelerated Investor in Facebook. Join the free community. There's thousands of investors sharing ideas and strategies inside of our private Facebook group. Again, I'm so honored to host these guests, host these podcasts, share all this information to help you build your business, save more money, and build a bigger portfolio. We'll see you next time on Accelerated Investor. Hey, Josh here, and do you want to win a free Accelerated Investor t-shirt? All you have to do is give Accelerated Investor, our podcast, Accelerated Investor, a rating and a review on iTunes. Okay? Do that now. Then send us a screenshot on Facebook or Instagram or Twitter. What we're going to do then is every week we're going to pick our favorite rating and review, and we're going to send that person a free t-shirt and maybe, again, some other cool, fun stuff as well from Accelerated Investors. So, again, don't forget to take a screenshot. Leave a rating, review, take a screenshot, send it to us so we know exactly who you are. And then once a week, every week on the podcast, we will announce a new winner. Don't forget to take a screenshot and send it to us so we know exactly who you are. We'll announce a new winner every week.
You've been listening to Josh Cantwell and the Accelerated Investor Podcast. Leave a comment on our iTunes channel and let us know what you want to learn next or who you'd like Josh to interview. While you're there, give us a 5-star rating and make sure to subscribe so you can be the first to hear new episodes. Follow Josh Cantwell and his companies, Strategic Real Estate Coach and Freeland Ventures, on all social media platforms now, and stay up to date on new training and investment opportunities. To start your journey toward the lifestyle you've always dreamed of, apply for coaching at joshcantwellcoaching.com.